saludamos a James Athey, Investment Director at Abrdn. James, good afternoon. Thank you so much for attending us.
Hi, good afternoon. My pleasure.
So, the Bank of England raised interest rates by 50 basis points. This would be within expectations. However, they warn that GDP growth will slow sharply and inflation could peak at 10% this year. Where does the UK economy go?
The outlook is not particularly bright and somewhat concerning, I have to say. There is a lot to analyse, but just specifically with respect to the Bank of England today and their decision, I found it very confusing. It seems that there are dramatically different views within committee members, but most concerningly, I think, from my point of view, some of the most important lessons that we learned through the 1960s and 1970s with respect to central bank policy making, inflation, and indeed the relationship between inflation and the economy have seemingly been forgotten. What we learned in the 70s was that unemployment and inflation were not the trade-off that had been previously thought. And indeed, if inflation is allowed to become embedded such that wages and prices are rising and feeding off one another, it is a very, very damaging economic situation to be in. And the growth consideration really in that circumstance is secondary. It is much more important to control inflation expectations over the medium term than it is to try and support growth in the short term. What I've seen from the Bank of England today really does suggest that certain committee members, particularly the internal bank staff, seem to have forgotten that lesson. So I do think we're headed for a very difficult economic situation in the coming months.
Okay, what do you think about the market reaction? Sterling plunged nearly 2% against the dollar and the euro. It's worst daily decline since March 2020. British bond yields are falling sharply as well. So how do you explain this reaction? Is about what you just said?
Yes, some of it. I think the reaction to short-dated yields, which have fallen quite considerably, I think makes sense. Essentially, the Bank of England looks reluctant to hike rates to the same extent that we're seeing amongst most other central banks the world over. The Bank of England is dragging its feet, and I think the market was priced for a more hawkish outcome. That makes sense to me. And sterling falling most certainly makes sense. I mean, this could be a really, really nasty combination for sterling. High inflation, low nominal rates, very negative real rates, a central bank reluctant to grasp the nettle at a time that other central banks are being very hawkish. That will cause some real pressure on sterling. And furthermore, the UK imports a lot of goods. A lot of the CPI basket is made up of imported goods, and when sterling falls, the price of those imported goods, including obviously key energy commodities, will increase in sterling terms. That pushes inflation higher. That's a standard feedback loop that we see acting very damagingly in places like Turkey. So that's something really to watch. The one that doesn't make so much sense to me is that 10-year yields have fallen as much as they have. I think in a situation where the Bank of England appears not to want to hike rates as much as I believe they should, but is still talking about the sale of assets from its balance sheet, I would have expected actually long yields to probably rise a little. So short-dated yields lower, long-dated yields higher to reflect greater inflation premium and the potential for gilt sales. But certainly the sterling weakness, I think, is a very rational reaction, and I have concerns that that could move further.
Mm-hmm. Given this reaction and given the reality that some members of the committee are thinking about the 50 basic point hikes, do you think we will see these hikes in future meetings?
Well, it's interesting that the three members of the committee that voted for a 50 basis point hike today are all externals. And it has been the reality for the Bank of England for as long, really, as they've been independent. So since the Labour government released the bank to be independent in the late 90s, it has been the case that internal committee members, i.e. those who are permanent employees of the bank, have tended to act together and have tended to be at the dovish end of the spectrum. And so what we see again today is externals, I think, recognising more seriously the risks of a dovish policy, but internals grouping together, being more cautious, being more dovish, systematically, regardless of the outlook. And so I have fears that it may take a more shocking inflation print or two to push the internal members towards a 50 basis point hike. So for now, it's not my base case.
Mm-hmm. And how will the Bank of England reduce its balance sheet?
It's a good question. I mean, this is I think one of the most interesting dynamics of this current time. There's a lot going on for bond and macro investors such as myself to try and get a grasp on. But asset sales from these gargantuan central bank balance sheets is not something that we've had to deal with before. It has been a one-way train, and even when the Fed reduced its balance sheet through 2017, 2018, it did so in a passive fashion. It just allowed coupons and bond redemptions to go unreinvested, if I can make up an English word there, in order to reduce the size of the balance sheet, whereas actual sales of assets, which the bank is considering, is not something that we've seen before. So to truly know what that would mean, we'd need to see details in terms of size and the composition of assets being sold, but it should be a reduction of liquidity and it should push yields higher.
So, James Athey from Abrdn, thank you so much for attending us. It was a pleasure.
Thank you very much. My pleasure.